Welcome back to our second presentation on efficient market theory, who can beat the market? And we're going to take a look at some investor psychology. Psychology, is that the study of psychos? I prefer to call it psychology. We use psychology on them. In 1962, there was a brief recession and a sharp market downturn. The president's chief economic advisor was giving a presentation to many of the political and economic leaders of the time, describing what they were doing to right the economy. One of the attendees asked, "So when is the stock market going to recover?" The advisor curtly responded, "I am an economist, sir, not a psychiatrist." Right, we're not rational beings, we're not computers, we're humans, we are irrational. And so, what we have done is try to analyze ourselves. Because of the tremendous amount of money involved in the markets, much research has gone into trying to understand investor psychology. And some of the research is very revealing about who and what we are, not only as investors, but also as a species in general. And there's an old Wall Street saying, there are three factors that influence the markets: fear, greed, and greed. If anybody says to you, "Oh, it's fear and greed, you say, no, 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 no. It's fear, greed, and greed. Because greed usually wins out in the end, which that's, part of being human. We see Bozo down the street making a ton of money with kleptocurrency. We want to do it too. Don't worry. What's the saying? You hear the saying now. Scared money don't make money. Oh boy, what is the old saying? The other one. If you don't know who you are, the stock market is a very expensive place to find out. So let's take a look at some common investor weaknesses. Reading too much into the recent past. Beware the permanent trend. Courtesy of Andrew Tobias. There's no such thing as a permanent trend. A trend is temporary. Even though there are countless examples of investors getting on the bandwagon just as the wagon was about to veer into a ravine, we trick ourselves into believing that it's different this time. It's a new era. Ooh, is it too late to get in? Now, some of you weren't even born yet, but does anyone else remember eToys, theglobe.com, or CMGI? What was CMGI anyway? It really didn't do anything. It was just a company that was associated with the internet, and so its stock exploded. How about condo conversions in 2006? Or oil in mid-2008 when it hit $147 a barrel, and 8 months later it was $39 a barrel. And gold in 2012 when it levitated for no apparent reason other than people thought it would keep going up. Will we add cryptocurrencies, SPACs, whatever they stand for, special purpose, some acquisition companies, and NFTs, non-fungible tokens, to the list 5 or 10 years from now? Well, I think so. But the thing about these cryptocurrencies and these NFTs is, as we said in the previous presentation, you can just keep creating them. There's no end to the number that you could create. When it came time for the condos to bust in 2006, well, you're not going to get any more funding to build new ones. And when every few weeks or every few days a new company was going public, well, the appetite for those disappeared. But all you got to do with a kleptocurrency is start a new one. There are, 6,000 or 7,000 of them at the time, and get some celebrity to hawk the darn thing and say how wonderful it is. And you get a whole new crop of suckers. Oh well. How about misperceiving randomness? Even though stock price movements in the short term are random, our brains will trick us into seeing a pattern because we humans are heuristic, which is a fancy way of saying we look for patterns. Even if we know that there aren't any to be found, we superimpose one on the situation. A great example of this is random. We look at a series of random digits and we say, oh, well, that's not random. Well, if you looked at a series of 1 million digits, the probability that one of those digits, 0 through 9, you don't know which one, but the probability that one of them will be repeated 13 times in a row is essentially 100%. So if it doesn't happen, if we have a series of 1 million random digits and we don't see at least one repeated 13 times, then we can assume that this is not a random series of numbers. Somebody's fudged the numbers. But of course, if we came across those 13 digits, especially if it happened towards the beginning, as we started scanning the list of numbers, we would just say, no, this can't be random. But it is. And in my humble opinion, this is what technical analysts are guilty of, this phenomenon. And we're going to discuss that in our next chapter. And what happens is you give them a random, just completely random. It's just totally random, using a random number generator on a computer, just completely randomly generated. And they say, look, this means this means this. The stock's going to go up, but this is not real numbers. It's just random. But they're so wired to see these patterns. So we misperceive randomness. We are overconfident. We believe that we know more than we actually know, or we believe that we're better than most other investors. The truth is, folks, when you're an individual investor, you only see the tip of the iceberg with regard to what's happening within a company, an industry, or the economy. And when we get to Peter Lynch, he has this book called One Up on Wall Street. He believes that some people have an inside track because they happen to work in the industry or they're a customer in the industry and they see things before the general public becomes aware of it. But in general, no, we only see the tip of the iceberg, especially with companies that we have no experience with at all. People would ask me about retail companies. I say, I hate shopping. I'm the worst person to ask. And we're usually only average or mediocre investors at best, especially if we decide to become traders or speculators. Yeah, we're up against the best in the business, folks. This is actually, there's a name for this, actually. It's called the Lake Wobegon effect. If you ask 100 people, are they excellent, good, average, fair, or poor drivers? Typically, you will get 80% of people who will say they are excellent or good. Right. 80% out of 100, that's 80 out of 100. No. Where's the average? You see, everyone believes that they're a good driver or an excellent driver. And the same thing is true when people start to trade. They think, oh, yeah, I'm a great trader. And they talk about the one trade they made. They made 300% in 3 days. And they forget to tell you about the other 7 that zeroed in overnight. And it comes from the mythical town of Lake Wobegon, where all the women are strong, all the men are good looking, and all the children are above average. We saw the Lake Wobegon effect as our son was growing up, because everybody's child was gifted or something. We kept saying, sure, you got to record. Oh yeah, sure they are. You're right. Okay, average is good enough for me when it comes to an individual and a driver. Just be careful out there. But when it comes to investing, right, don't be overconfident. Realize your limitations. And then selling your winners too soon and holding on to your losers. This is called loss aversion. And this was discussed quite a bit in that book I told you about, Thinking Fast and Slow. Daniel Kahneman and our facts that the fact that we're not rational. As humans, we hate to admit we make a mistake. So we stubbornly hold on to our losers, hoping they will at least get back to where we bought in. The reality is our memories are wired to forget unpleasant experiences. If you sell your losers, you'll quickly forget about them. But if you hang on to them every time you look at the screen, you'll be reminded how stupid you were. Oh, yeah, it's down to $10. I bought it at 10, it's down to 3. I want to wait until it gets back up to 10. No. Time to sell, go on to something else. But in contrast, hanging on to your winners is what makes an investor rich. So hang on to your winners now. keep doing your research, reevaluate regularly. Has the stories changed? Is another company coming along that's better? The better investing folks say it's time to trim our portfolio. But there's a wonderful story from Peter Lynch, again, one of the all-stars we'll talk about in a little bit. When he was asked, Mr. Lynch, what was your worst investment? And he said, well, Home Depot came out and I bought it and it went up 100%, doubled my money, and I sold. And they said, that was your worst investment, Mr. Lynch? He said, yeah, it then went up 20 more times. You see? So hang on to your winners. Get rid of your losers. Make mistakes. You're going to make mistakes. Everyone makes mistakes. But continually reevaluate what's the future. And sometimes, you have bought a stock and now it's 60% of what it was, right? But the story still looks really good, so maybe it's time to buy more, right? Check all your resources. Don't forget the value line, my favorite resource. But just because Peter, I'm not Benjamin Graham. We talked about this in the previous discussion, where Benjamin Graham would say, the market is giving you an opportunity. Take it, take it, because there's going to be times when the market falls substantially, and those are great opportunities. But remember, you're not going to wait like Warren Buffett or Leonard Kaplan until the entire world ends and there's blood in the streets. So have a little bit of, they say, keep your powder dry for a little bit of when there's a downturn, as there is, from time to time. And now, so those were common investor weaknesses, which hint, 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 may be on an exam. So make sure you know those, okay? Now, let's revisit our discussion, our controversy over passive management index funds and active management. This slide we showed you back in chapter 2, and we said that you're probably not going to understand it that well because you haven't been exposed to price to earnings ratio. So if you recall that passive management relies on those indices, those Standard & Poor's 500, the Dow Jones Industrial Average, NASDAQ, the Frank Russell 2000, the All Country World Index, ex-USA. Instead of trying to beat the market efficient market theorists say just buy the market and be happy with the market return. But there are some times when an index becomes skewed or bent out of shape or concentrated in a single area of the industries and the sectors of the market, especially when a sector or a region of the world becomes hot, meaning very attractive and people just keep throwing money at it. So now let's take a look at the EFA. Remember, Europe, Australia, and the Far East, and the Standard & Poor's 500 at different times. In the 1980s, it wasn't China that was going to take over the world. It was Japan. And there was a song, I'm Turning Japanese. And the Japanese stock market went in two directions, way up and way up, to the point where at the end of the 1980s, the Japanese stock market made up 60%, 59.8% of the EFA. Remember, Europe, Australia, and the Far East. So Western Europe, Canada, South Africa, Hong Kong, Singapore, Australia, Japan, those places. But with a PE of 51.9, which we now know, that's pretty high. And if things don't keep going the way they're going, the parachutes had better be very large because that PE is going to fall dramatically as the price falls. Everything else, Western Europe, Canada, South Africa, Hong Kong, Australia, Japan, not Japan, Japan's up here, was 40% of the index, but with a very reasonable PE of 13. So you bought the EFA thinking you were getting a very broadly based, diversified index portfolio of stocks, when in actuality you had 60% in Japan. What happened next? Well, Japan proceeded to lose over 80% of its value and has never touched where it was back in 1989. But of course, many of those companies disappeared, so that's the problem with index funds. The same thing happened in the year 2000. In the 1990s, the Standard & Poor's 500 went in two directions, up and way up. And everyone said, oh, me some too. I want the index. Don't worry about beating the market. I just want the index. Well, at the bubble, peak of the bubble, March of 2000, the Standard & Poor's 500 consisted 33% of information technology. So companies like the internet companies and the software companies and the computer companies and AOL, America Online, one of the new, the disrupting companies. They didn't call them disruptors at the time. With a PE of 59, which we now know is very high, nosebleed. Everything else, energy, healthcare, building materials, real estate, the consumer products, railroads, everybody else made up 2/3, 66.7%, with a PE of 19.3, which is fairly high, but not outrageously high. So you thought you were broadly diversified, but in reality, 1/3 of your portfolio was in one sector of the economy, information technology, with a very high price to earnings ratio. In other words, very expensive. What happened over the next 2.5 years from March of 2000 to October of 2002, Standard & Poor's lost about 500, lost about 50%. NASDAQ lost over 80%, the tech sector. And the Internet Index, which had just been created by Merrill Lynch, it dropped to 94, 95%. So what's going on now? If you did that, and you still can, folks, you can turn in your assignments late. Bonus assignment for Chapter 2. You saw that the top 10 companies in the Standard & Poor's 500 made up a very large, I'm not going to tell you how much, I want you to go figure it out, why don't you go find it out, a very large percentage of the Standard & Poor's 500. These are the companies that, we all talk about, Apples and the Amazons, and they're the top, they're huge, $1 trillion companies. And so we want you to do that bonus assignment. It's worth 2 points, okay? And you'll see that indexing, just like every strategy, has its pros and its cons. Right, exactly. Nothing is absolutely perfect. All investments have advantages. All investments have disadvantages. And so the argument for active management is as thus. Today in the financial media, passive management is touted as the better alternative to active management. As we did see, though, index funds do have the advantage of very low-cost investing. Be careful unless your third-party administrator sneaks a high-cost index fund into your 401k. Watch out for that bozo. You're going to call him out, and your friends and family are going to say, friends and coworkers are going to say, wow, aren't you smart? Where did you learn that? And you're going to tell them Business 123 investments. But decades ago, Benjamin Graham warned against any investment strategy that relied on deterministic or robotic decision-making and removed the element of human judgment. Now, Ben didn't live to see the world of indexing explode. I don't know what he would say now. I think he would probably say, it's great for people who aren't going to do the research. Kind of like what Warren Buffett says, if you're not going to do the research, go ahead, get an index fund. But we find, and that's part of what we asked you to do in Chapter 2 with mutual funds, and go look for companies that have been around for decades and have beaten the S&P 500 and the All Country World Index, actually the World Index I think we used. And so they're out there, right? And here's a gentleman with over 35 years experience. He's since left the industry, but he was one of the ones who did. As with any human endeavor, whether it is athletic competition, the performing arts, or technological innovation, some people clearly perform at a higher than average level. Can you hit a fastball at 98 miles an hour? Can you sing a 4-hour opera in front of the Metropolitan Opera where the customers have paid a ton of money to hear you and they want you to be very, very good? Can you write a best-selling novel? Can you direct a $100 million plus budget Hollywood blockbuster movie? Most of us can't, right? Most of us can't dunk a basketball. Most of us can't hit a little white ball 300 yards in 2-3 shots. But there are people who can. And those are the people that I want to be managing my money. And realizing that they're human, they're going to make mistakes. But that's my view. The index funds have their own problems, as we discussed in chapter 2. When a stock becomes very expensive, the index fund manager has to buy more. They can't say, you know what, this is a great company, but it's just way too expensive. And so that drives the price up even higher, right? It's a self-fulfilling prophecy, a feedback mechanism. When a stock has hit on bad times, the index fund manager has to sell. They can't buy more shares. And they can't say, this is a great company, but wow, their stock has been destroyed. I'm going to buy more. No. So for that reason, I'm firmly in the camp of, I want to find good money managers that have done well over decades, and I'll stick with them. And other people say, no, he's an idiot. You want index funds. Now be careful, by the way, if you discuss this with certain people and you say, well, some of these actively managed funds are actually very good, they will accuse you of being a shill, accuse you of being somebody who just a fanboy. I hear the term fanboy, and okay, what are you going to do? Don't argue with them. Don't discuss it with them. Now let's take a little bit of time and talk about some silliness. Oh boy, it's amazing what people write about, speak about, and get away with in this nutty world of ours. The Monday effect. It's a good time to buy. Or is Monday a good time to sell? You're not supposed to buy a car that was made on Monday or Friday afternoon. The January effect. As go January, so goes the year. Well, you know what? That's just a new year. You can pick any month of the year. Why? Because the stock market typically goes up 3 times more often than it goes down. So you can pick any month of the year. As that month goes, hey, the rest of the year is going to go that way. Except for September and October. The Santa Claus rally, sometimes called the turn of the year effect. Well, December tends to be a good year, but not always. If it isn't a good year, they say, oh, people are selling because of tax reasons. They always have something to say. Sell in May and go away. Now, this one actually does have some merit to it, although for long-term prudent investors, it's not something you want to think about, in my humble opinion. But the truth is, the stock market has done better between November to March than it has from April to October. Now, why is that? Well, we discussed in the previous presentation that September and October are actually the worst months. People are starting to panic. They don't know that they are. It's something that's built into us for millions of years of evolution. So if you were to try to trade on this information, though, you're going to basically just lose to commissions, because over the decades, the amount is minuscule. It's less than 1%. So I just recommend to people just to ignore it. There are some times when the months of summer are actually the best months of the year, but often they're not. But we're long-term investors. We don't sell just because the thing's gone up 5% or gone down 5%, and we don't buy just because it's gone down 5%. We don't sell because it's gone up 5%. We are looking for 3, 5, or more years of investment returns. Now, the next one, believe it or not, is there's some reality to this. The Super Bowl theory, and every year they trot it out. If a National League team wins, then the stock market's supposed to go up. If an American League wins, the stock market's supposed to go down. The weird thing is, it's been pretty true. Okay, what's going on here? Well, if you look at the comparison of PhDs in chemical engineering and cheese consumption in the month of April, you'll find the same kind of relationship. Whoa! So, in other words, can you say coincidence? There are all kinds of strange coincidences, but because there's a lot of money to be made in the stock market, they trot this thing out and discuss it. There's the hemline theory, as miniskirts became popular in the 1920s and 1960s. Hemlines went up, stock market went up, and then in the 1930s and 1970s, skirts went down and the stock market went down. All right. And then there are all types of silly theories, such as the lipstick indicator, the Boston snow indicator, also called the BS indicator, the incredibly sexist, misogynistic hot waitress indicator, and then the amount of aspirin that is being consumed. Folks, they're out there. Go ahead if you're interested. Take a look at them, but please don't trade or speculate on any of these. And by the way, let's take a moment to talk about politics in the stock markets. Poly means many, and ticks are blood-sucking insects, right? There is a tremendous amount of rancor and you could say hatred between the two parties now. It's very sad. They used to play nicely in the sandbox, but not anymore. But don't let anybody tell you that the Democrats are anti-capitalism. Both parties are committed to the capitalist system. Now, there's quite a bit of disagreement over the amount of regulation and taxes and the like, but nobody wants to go back to go to a communist system. Even the so-called socialists, they say that they're more of a Northern European social capitalist system, which the Republicans use to bound them over the head, but they don't want to. They don't want to go to a Soviet style or Chinese style capitalist system. I mean, a social communist system. And it turns out that when you look at the party in power at the White House, the Democrats actually have the edge. Now, this is a lot of it due to just dumb luck, just bad luck. Hoover coming in right before the Great Depression, and then Franklin coming in the midst of the Depression and coming out of the Depression. And then same thing happened with Nixon coming in right before the 1972, 1973, 1974 crash. The brutal bear market. Same thing happened to Bushes. Both Bushes got hit hard. And people like Clinton, like charmed existence, he comes in right when the stock market zooms up, and then Obama came in at the bottom of the 2008, 2009 bear market. So even though the truth is the Democrats have done better, again, it's a lot of it just dumb luck, So both parties are committed. Now, there's a lot of controversy over how it should be done, and that's good. We need to throw out ideas and stop yelling and haranguing one another. I hope. I don't know. We'll see. Okay, let's continue. Now, finally, yay! Let's talk about the all-stars of investing, because this is one of my favorite topics. These are people who have done very well over decades, and I always believe if you want to learn from the best, right? Steal from the best. You're going to steal. Peter Lynch, we told you to read his book. I don't know how many times have I told you to read his book, One Up on Wall Street. He was the fund manager of the Fidelity Magellan Fund from 1977 and 1990 and racked up 29% a year Oh my goodness. And that's why Fidelity Magellan is one of the top mutual funds over decades, even though it has never gotten anywhere close to that kind of return since Peter Lynch left. But he says, buy what you know. And he's been accused of just being very simplistic in his advice. And he said, hey, you wear Nike shoes, you drive a Chevy GM car, you drink Adam Smith beer, or whatever it is, Samuel Smith's beer. Maybe those are good investments. Now, he never said just buy it without doing your research. I mean, some people have accused him that. It's not true. It's not true at all. But he really does believe that if you're out there in the world and you're seeing people buying these devices that you fit in your ears, and this, 20 years ago, maybe that's something we should look into. And also, as I said, it's a fun book to read. It's a lot of fun. He's got a great droll sense of humor, and you'll enjoy it. Warren Buffett, we've discussed him, and we've said that he says don't buy a stock, buy a business, buy a company. He puts the emphasis on the value of the entire company. And he said if you could buy a FedEx or Home Depot or Nike or one of these companies that you admire, and you'd want to own that company because of it's an awesome business, go ahead, buy 10 shares or 5 shares. Now, of course, he's got enough cash, he buys the whole company. Benjamin Graham was Warren Buffett's teacher. He's often called the father of value investing, and he wrote that wonderful book called The Intelligent Investor, which you're going to read eventually. Don't read it as your first book. And then Security Analysis, which is a whole lot worse. I shouldn't say a whole lot worse. A whole lot more detailed, more rigorous. But we learned some of the techniques that he talked about in the book. So it's your graduate level book. Benjamin Graham passed away, as we said, in 1975, but he has his legacy lives on in Warren Buffett and those of us who believe in buying for the long term and paying a fair and decent price and loving dividends. Sir John Templeton was one of the first mutual fund managers to invest globally, and he left a legacy of investment advice and spirituality. So you can go to his website, and it's an interesting read. It's a great a place to hang out. His website, dedicated to his investing beliefs and concepts and skills, and his belief that spirituality is sorely lacking in our modern world, and how can we reclaim that without without killing the people who don't believe like we believe. And then Bill Miller. Poor Bill Miller. Now, don't feel so sad for Bill Miller. He did really well for himself. Remember the Legg Mason Value Trust that we discussed back in Chapter 2? Yes, for 15 calendar years in a row, he beat the S&P 500. An unprecedented record. And unfortunately for him, as far as I'm concerned, and he wasn't too happy about it either, he became the financial media's megastar. He kept saying, well, that's just because January. You picked January. If you had picked May or April or another month, I wouldn't have done it 15 years in a row. What happened? He did not beat the S&P 500 in 2006 and then did badly in 2007 and 8. During the turmoil, he started to redeem himself in 2009. But then trailed badly in 2010, 2011, and finally left in 2012. And so this was the example of the mutual fund that we saw that badly lagged the Standard & Poor's 500. Now, when people would say to me, why, well, this was in 2005 and 6 when he had just destroyed everybody else. Why don't you invest with Bill Miller? Do you invest with Bill Miller? No, I don't. Why not? Well, because he's very concentrated. What he would do in his mutual fund is he'd have about 40, 45 stocks. He was a big fan of Amazon. And that works great when you concentrate and your choices do well. But when you concentrate in the mutual fund and your choices don't do well, exactly, it's a two-edged sword. You live by the sword, you die by the sword. And so he got really hammered. And it shows in the long-term results of the Legg Mason Value Trust, now called the ClearBridge Value Trust, another example of burying the evidence. He's now gotten involved in some other things, so he's still around. So check him out. If there are interviews you can look up on YouTube and the like, and readings about him. So he's still around though, but he doesn't work for Legg Mason anymore. What do all these people have in common? Well, they have the courage to not follow the crowd because the conventional wisdom is usually not very wise. And they have what I like to think of as an eye for unrecognized value. You can think of it like a sixth sense. They see things that other people don't. And everyone sees this thing about this company and they say, oh no, you're missing this. Garry Kasparov was once asked why he and Anatoly Karpov were the two best chess players in the world. His answer was astonishingly simple and direct. We attack better than anybody else, and we defend better than anybody else. So how can you argue with that, right? Garry Kasparov and Anatoly Karpov were the two best chess players in the world, and they kept fighting one another. And finally, Garry Kasparov became the undisputed champion. This was back in the 1990s. And then he was beaten by a computer. Ay, ay, ay. We attack better than anybody else, and we defend better than anybody else. It's not bragging if you can do it. And so these people, they bought the best companies and avoided the worst companies. So it's offense and defense. There's the reward and then there's the risk. And speaking of avoidance, as a mutual fund investor, which I mostly am, I am not looking to find the next Peter Lynch or Bill Miller or Warren Buffett. No, I'm looking to avoid the next Charles Steadman. And you say, well, who is Charles Steadman? Look him up. It's not a good story. He ran his own mutual fund, the Steadman American Industry Fund. That's a bad sign, naming it after yourself. From December 1959 until his death in late 1997, and his cumulative total return was minus 42.9%. During one of the largest expansions in the history of the world of the global economy, this guy lost 40% of the money. He would have done much better simply placing the investor's funds in a savings account at a bank or putting it under a mattress. I don't know, maybe he came from the life insurance industry where they just love to lose your money. So you see, I want to avoid the next Charles Steadman. I want my mutual fund manager to show a consistent, not necessarily the best, the brightest, the guy on the Vogue and GQ and Vanity Unfair and the covers of those magazines and shown on the television and like, but the $200 haircuts. I want the mutual fund managers who have done it many years and have not made the limelight, but have done very well. Yeah, good enough. I don't have to win big. I just have to win. Okay, so let's take a look at what some of these people say. And we've already discussed some of these ideas. Warren Buffett says, be fearful when others are greedy. Be greedy when others are fearful. In other words, invest when there's blood in the streets. His mentor, Benjamin Graham, said in The Intelligent Investor, buy when most people, including experts, are overly pessimistic and sell when they are actively optimistic. Here's John Templeton's take on it. Bear markets are born of pessimism, grow on skepticism, mature on optimism, and die on euphoria. The time of maximum pessimism is the best time to buy. And on a similar note, he also said to buy when others are despondently selling and sell when others are avidly buying requires the greatest fortitude and pays the greatest reward. Now, did Sir John Templeton put his money where his mouth is? Did he follow his own advice? Oh, yes, he did. Now, you're going to want to research this because there's a few different versions of the story. But January 1941, Pearl Harbor. The United States is finally dragged into World War II. And the Japanese have destroyed 1/3 of the Pacific Fleet. And Hitler has run ragged over Western Europe, and he's in Moscow. He's close to Moscow. And it looks really bad for the free world. John Templeton calls up his broker and asks them to buy every bankrupt company selling for under $1 on the New York Stock Exchange. Now, again, the story changes, but that's the idea. He jumped in with both feet forward and bought all the companies that were selling for, whatever, $1 or whatever on the New York Stock Exchange. 4 years later, the war is over. It's 1945, and Sir John Templeton, who isn't royalty yet, he's not Sir John Templeton yet. He's a very wealthy man. Would you have that kind of chutzpah to jump in at the time of maximum pessimism? It's the best time to buy, when there's blood in the streets. Famous myths and stupid sayings. Now, I took these, not quite verbatim, but pretty darn close, from One Up on Wall Street. So you're going to read it, right? Right. It can't go any lower. Oh, yes, it can. It can go to zero. Once it goes to zero, it can't go any lower. Then you're right. Then it can't go any lower. But till then, it's only $1, $3. What can I lose? Everything. You can lose everything. The price can go to zero. You can lose all your money. Remember, price is irrelevant, the market price. What's the market capitalization? And the same thing is true when a company's going up. When it can't go any higher. Well, there's no speed limit. Hit $100, that's it. It can't go any higher. If the earnings are continuing to grow, there's no limit to how high the price can go. It has to come back. No, it doesn't. There are examples, numerous examples of companies that were, bedrock companies to the economy. And one of them was Penn Central, a railroad that had been around for 150 years that was, at the time, the largest bankruptcy in our history. And in The Intelligent Investor, Mr. Benjamin Graham discusses this bankruptcy and how if you had been doing the research that we do, you would start to see that things aren't what they appear to be. And so when you read The Intelligent Investor, remember Penn Central and remember Mr. Lynch. Benjamin Graham, Mr. Benjamin Graham, The Intelligent Investor. It's always darkest before the dawn. Yeah, well, sometimes it's always darkest before it's pitch black. When it rebounds to $10, I'll sell. Now, this goes back to the loss aversion, right, that we talked about. Stock has no idea you bought it at $10. If you would now not buy it at this price, you made a mistake, time to sell, reallocate the capital, and be done with it. If it goes down 10%, sell. Now, I understand why these are mostly traders and speculators. They're trying to save you from a large loss, right? They want to get a 20% up or 10% down, and they set it up using the stop loss trade that if it goes down 10%, boom, they're out. They stopped out. The problem is stock prices fluctuate greatly. If you always sold a stock that lost 10%, you're going to wind up selling everything. Always sell your winners along with your losers. It's taking too long. Well, this is true. It is not, unless you're going to play the buy and sell speculation game trader, it does take a long time. But that's a good thing because you have plenty of time, right? You don't have to strike it rich right now. Patience is an investor's most important trait, and it gives you a chance to buy more. So you're going to be buying $50, $100 a month, like the rest of us working grunts from our paycheck and our 401k and our Roth IRA from our checking account. Ooh, not very exciting. So it is a good thing that it takes a long time. Look at all the money I lost. I didn't buy it. Coulda, woulda, shoulda. Don't lose a cent. You don't lose any. Don't fret over money you did not make by not buying a stock. Just concentrate on what's in front of you. I missed that one. I'll catch the next one. The problem is the next one rarely makes it. You're going to wait for the next Google. Microsoft has been trying to supplant Google for years with their service called Bing. It doesn't seem to be doing a good job. DuckDuckGo, which I don't even think is a public company, is trying to nibble at Google's feet, nibble at their toes. But again, buy the next Microsoft, buy the next Apple. Look at those companies, right? But in one case, Home Depot, right? Buy the next Home Depot was Lowe's. So Home Depot kind of allowed Lowe's to horn in on their cookie jar there. The stock's gone up. I must be a genius. Well, there's an old saying, never mistake a bull market for brains. Because just because the market's doing well, you're going to think you're a genius. There's that old saying, a rising tide lifts all boats, but when the tide goes out, you can see who's been swimming naked. And if you talk to market professionals, they will tell you that if they got in right as the market was zooming up, right after a bear market and things were doing really well, they will tell you that was a bad thing because they started to believe they were invincible. Every stock they picked, oh my goodness, this is doing well. I'm a genius. I'm a genius. And then comes ooh, I'm not a genius. And so you will talk to market professionals who started at a bad time, and they will say that was good for them. It taught them humility, and it taught them to watch the downside. Because the same thing is true on the downside. The stock's gone down, I must be an idiot. No, not necessarily. Just because you picked the stock that, for some reason, especially if you're involved in small company stocks, where they can get just hammered for nothing that they did, and it wasn't their fault. Not so much of a problem with really large, well-capitalized companies with the roots deep in the economy, but it is an issue. So don't worry, just because the stock's going down, you're going to make some mistakes. There's no way to get around that. And then when you hear these, that's when it's time to run. That's when it's time to realize, oh my goodness, we're going to go through it again. It's different this time. Well, yes, technically it's different every time. But that doesn't mean you should pay an astronomical price for a company that probably will never make $1 worth of profit. Those were the internet stocks. It didn't look like they were ever going to make money. And of course, they didn't last. Or things like NFTs, where it's just plain simple buy high, sell higher, the greater fool theory. It's a new era. It's a permanent trend. What? That's an oxymoron. Like jumbo shrimp or straight curve. There ain't no such things. Markets move in cycles. So when you start to hear people say, ooh, is it too late to get in? Don't necessarily sell, folks. Maybe if you're a growth-oriented investor, you might want to, as the betterinvesting.org people say, trim your holdings and look for more defensive companies. That's up to you. But just realize that we're going to go through a tough time, and we've been there before. We'll be there again. And then lastly, what's going to happen? When people hear that you're involved in stock investing, some of them are going to come up to you and say, well, they're just too darn risky. And this is a great opportunity for you to acknowledge that, yes, stocks are risky. But even with all the financial shenanigans and the stupidity, the silliness, and the hanky-panky, they're still the best long-term financial investment, in my humble opinion. And providing the world doesn't end, the future looks pretty good. We'll see. We'll see. And that, dear students, is our discussion of market efficiency theory. Who can beat the market? And we're ready to tackle what we've been dancing around, the last major investment strategy, and that is technical analysis, reading squiggles on a screen. And in reality, dear students, somebody else should teach you this, because my heart is not in it. I don't trust technical analysis. I don't believe it's a valid form of investing. It's for speculators. It's for traders. And I wish them lots of success, because they're going to need it. See you in our next presentation on technical analysis, reading squiggles on a screen.